This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
Let's start with what could possibly be the biggest financial news, at least of this year, but maybe of the decade, of the 21st century, even so far. We now live in a world of trillionaires. As you all know, everybody has seen the headlines. Elon Musk, there's a first for everything, and he is the first trillionaire amongst us. The IPO offering around SpaceX. Mm-hmm. It's been a few weeks now, so the dust has settled a bit, which is a good time for us to have this conversation, Abe, here on the radio. You listening to us, you've heard that initial IPO for SpaceX was offered, raised $75 billion, shattering records. Thinking about the folks that you work with, they're close to retirement, but still, maybe they want to buy in to SpaceX or other IPOs that might come along in the near future or in their retirement. What are their options? What do we need to be thinking about in this space? This is wealth manager Barry Ritholtz on Fox Barron's Roundtable.
Historically, IPOs begin to underperform not long after the offering, and mega IPOs have a history of coming out of the box hot and then cooling off. There's no really earnings history. If you want to take a speculative gamble and roll the dice, go ahead. But, there's a reason why the S&P 500 said we're going to wait a year to admit this. Let's make sure that the company really is ready for prime time. It's always hard to tell at an IPO level.
All right. So thoughts on this? I mean, I don't know if you have any thoughts specifically to SpaceX's IPO. And also when it comes to folks that are calling you, what are people asking you about this IPO or other maybe tech opportunities? And are they chasing the next big thing? How are you guiding people in this space, Abe? There's a lot.
Yeah. Well, look, we had a lot of people reach out, a lot of clients reach out, showing interest and expressing interest in buying the stock, right? I mean, it's hard to bet against Elon, one of the maybe most successful human beings that's ever walked this planet.
Certainly one of the most intelligent.
One of the biggest creators and visionaries you're ever going to see, and that we're ever going to see in our lifetime, probably. Mm-hmm. So it's hard to bet against him and what he's creating, because usually it turns into a very successful outcome. Mm-hmm. So there's that. But, talk about news and noise. It can be easy to chase the latest trends. It can be easy to chase the latest stock because markets like right now, the S&P is up 9 or 10%, but there are stocks out there that are up hundreds of percent if you just look at them and look for them. And then there are stocks that are obviously down too, but you really want to focus in on your own personal financial plan. With that, as a gentleman said, it was our understanding that it would probably be likely that in time, SpaceX would be added to common funds out there. So, you can obviously have exposure to the stock itself, but, we are pretty big on having a very well diversified plan and using funds like ETFs that, as an example, VUG, Vanguard Growth, is one of many ETFs that we'll have in our portfolios, often in there a lot of times. And in VUG, there's like 150 companies in just one ETF. And you'll have companies like Apple and Tesla and Microsoft, in those types of funds. And so, you'll probably end up seeing SpaceX in different indexes and different funds in the future, where you can also gain exposure, without chasing it. And usually what I've found in my career, and I haven't been around forever, but I've been doing this now for over 20 years, is when everyone's hyped about something and when everyone's talking about something and talking about getting in it and buying it, it's usually not the time to do it. Now, could be wrong with SpaceX, but man, we saw a lot of hype around it, right? So we'll see what happens. But the encouragement to our listeners is focus in on your own personal financial plan. Take a look at what you have, understand the pros and cons of it, and then make changes as necessary, right? Continue to ride out the positives that you have and then look for the weaknesses and try to improve those. Okay. We just recently worked with a 63-year-old single female, about $3 million saved, a 7 risk on our risk scale, that's 70-30 desired allocation between growth, 70%, and income and safety, 30%. Lives in Arlington, Virginia. That's where I grew up. Retiring in less than a month. So sometimes people don't give us a lot of time, Heather.
Right?
That, you know what? I'm retiring. It is what it is. I'm done. I'm burnt out.
Right into the finish line.
I've got my trips already planned. Yeah. What can you do for me, right? I need a retirement plan. Yeah. And this was her. She was planning on retiring at 65, but ended up retiring at 63. Tons of stuff in the corporate world for 40 years. Tons of stuff. Company stock, cash, real estate, 401ks, IRAs, a trust and a brokerage account. Wanting to make sense of all of this stuff. We call it the financial junk drawer that you accumulate over 40 years. And again, it is lots and lots of stuff. That doesn't even include real estate and insurance policies and all these things. So we put together a comprehensive phase 2 retirement plan for her. And what we found is through her Social Security and pensions alone, all of her bills and baseline expenses are covered.
Nice.
So any income that could be generated from a $3 million portfolio, if you just simply take the common 4% rule, now it's a generic rule, but 4% of $3 million is $120,000 a year. 3% is $90,000 a year. All that's going to be icing on the cake income on top of her pensions and Social Security. We helped her consolidate, streamline, put that financial junk drawer into a well thought out, consolidated, and comprehensive phase 2 retirement plan that's focused on income, protection, preservation, legacy. Healthcare was important to her as she's a healthy 63-year-old female, probably going to live a good bit of time.
Yeah.
And we know what the stats say there about needing long-term care down the road.
Yeah.
If you're 55 years old and older, you've saved $500,000 or more for your retirement and $500,000 of investable assets we can help you to manage. We want to offer you the same comprehensive retirement roadmap that helped this lady out of Arlington, Virginia, to learn how you can retire and learn if you could possibly retire sooner than you thought you could. That's one of our greatest joys here at Abich Financial, is to get people retired sooner than they thought. Complimentary.
Abe, you just mentioned how much joy it gives you to tell somebody that they can retire sooner than they anticipated. It's a real thing that we need to address.
Yeah.
Because amongst pre-retirees, it actually has a name. The 1 more year syndrome.
You see it all the time.
Listening,
all the time.
Looking at you, listening to us on the radio right now, who said to themselves every year for the last 4 years in a row, just 1 more year and then I'll retire. So
usually it's the wives that have to hear that, and the husbands are like, just 1 more year, babe, just 1 more year, just 6 more months, and the wives are like, you need to get retired.
I think it's going to be the opposite in my house. I'm pretty sure that Kyle is already like, because we're 45, he's already going, all right, so if we can retire at 59. And I'm like, retire at 59? You're crazy. We're working to 72, son. So, sometimes the ladies, we've got thoughts too. Is Shelly looking at you going, when are you going to retire?
I will say she definitely helps balance us, because I'm go.
You are.
Go.
Yeah.
And she helps to slow me down in a lot of ways.
Husbands and wives, we all work together to carry each other into next phases. So for you listening to us on the radio, though, whether you're guilty of it or you're nudging your spouse in the side, you're giving him that elbow in the side going, this is you. Listen up, pal. You keep saying to yourself, 1 more year. You keep working even though you don't really want to. For different reasons. Maybe you want to beef up your Social Security check a little bit more. And then you go to find out, doing the math, it doesn't really make that big of a difference. Or I know a big thing for a lot of people, Abe, is I want to work to 65 because that's when Medicare coverage kicks in. And that's real. That's real money for people in that space.
Sure.
So I get that. But when sitting down with folks, crunching the numbers, seeking space of opportunity, how often do you see folks stuck in this 1 more year mentality? And more importantly, how do you get them out of it if they don't need to be there?
Yeah, well, look, Heather, you can go at it alone. You can try to do all this on your own. And a lot of people just have a lot of learning and educating to do on what's required to have a successful retirement plan. Or you can hire somebody and have an experienced guide or Sherpa, like right there in the same car with you, ready to walk with you every step of the way. And that's how we help our clients. But when it comes to this, there's so much truth behind this. Look, the payoff for people isn't as big as people think.
Right.
When they talk about, I'll wait to 65, 67, I want to boost my Social Security, I want to get to that $1 million mark, I want to get to 2 million, whatever it is. That idea might sound smart, more income, more savings, maybe a higher Social Security check. But in reality, the financial gain is often smaller than expected, especially in your 60s. New contributions don't have a lot of time to compound, so that extra year or two may not meaningfully change your long-term outcome. And I just I just met with someone recently. I'm like, yeah, but if you continue to work, for that company's stock that you could get if you stayed 2 more years, is that $100,000 worth it? Is that
right.
$200,000 worth it for someone with a $3 to $4 million portfolio?
Right.
When you could be traveling to Italy and doing everything you want to do the next year or two?
Yeah.
No. I don't think so.
Yeah.
And it wasn't for this lady.
Okay.
You can boost Social Security, and delaying benefits can increase that Social Security check, with gains primarily coming from higher monthly checks. But those increases only continue up to 70, and real life rarely lines up perfectly, right? Health can change, jobs can change, market conditions can force earlier decisions that can reduce that expected benefit. And the trade-off is giving up time, as I just mentioned, that you can't get back. While the financial upside may be modest, the personal cost can be significant. Look at the time you could have been spending. Consider the time you could have been spending with your family, with your children, with your grandchildren, traveling, pursuing all the interests and desires that you could be pursuing if you weren't tied down by the job.
You and I have a mutual friend, Thomas Ebley, and he talks about all the time about how time is the only true currency in the world. And that's what if you're ever having to measure something one against the other, think about how much money you make in an hour. And so is it really worth that hour's worth of time that you spent in traffic trying to get to one side of town to save yourself $20 on a delivery fee? That was something that happened with me, and we had a whole conversation about it. It's an interesting perspective to have.
Yeah, a lot of truth. Good perspective.
Yeah.
We just recently worked with a couple out of Leesburg, Virginia, who kind of fit this bill here that we're talking about, with just trying to get retired and take advantage of being young and healthy in their 60s.
Yeah.
And they're out of Leesburg, Virginia, almost $4 million accumulated, more than that when you consider, cash in the bank, real estate, but I'm just talking about investable assets, market-based for the most part. 7 risk, also on our risk scale, 70-30, comfortability there with that allocation. Retiring in 3 years without an income plan. So here's a couple. We see this all the time. $4 million saved. Wonderful job of accumulation. Just not even sure how they can retire, how to put it all together, because all the focus, all the growth, all the dedication and time spent has been on the investment selection, getting to that number that they needed to hit. Now they've exceeded that number. It was either 3 or 3.5 million for them. So they've exceeded their investment goal number. And have a few more years to work to continue to put more away. And so now the ball's in their court, right? They can control so much because they have the money, more than enough money set aside to retire with dignity and confidence and to create that income that they really want in retirement. So we put together a new type of 70-30 portfolio with them where 30% of the assets were set aside for protection, for income, with some guarantees combined with their Social Security. And that 70-30 split with us here at Abish took care of nearly 70%, or I should say 30% of the portfolio, right, a little over $1 million, coupled with Social Security, took care of nearly 70% of their income needs. They were only $60,000 away from their income goal, with nearly another $3 million in the market to work for them, which put them at about a 2% withdrawal rate need from the stock market side of the portfolio. That's a pretty darn good place to be. Yeah. And that comes from 30 to 40 years of dedication and being prudent and being disciplined and being committed to saving and to getting there. So that's a great place for people to be when they come in and they realize all this, usually for the first time, sitting across from myself and our advisory team at the conference room table. And that's typically when people take action. I now know I have enough money to retire successfully. I know that I need a plan. Let's put together a new type of plan, a plan that is focused on protection, preservation, legacy, healthcare, creating income that I can enjoy in my healthy years versus maybe waiting too late. If you're 55 years old and older, you've saved $500,000 or more for your retirement, $500,000 of investable assets we can help you to manage. Nearly everyone that walks through our doors has not had a retirement income plan done. That's what we helped this couple with out of Leesburg, Virginia. Find out if you can retire and what it takes to retire, and then put together a plan that's monitored consistently. We want to offer that retirement income plan complimentary to the next 5 callers and others.
All right, so there's this headline that I saw online, and it reads, millions of Americans spend decades saving for retirement only to trip over their tax bills at the finish line. It went on to talk about having more than one type of account in our savings plan. That includes a pre-tax account, an after-tax or a tax-free account, and a taxable account. Do you think that we need to have all three of these accounts in our plans, Abe? How does all of this fit together, piece by piece in the pie? How do you help people figure this out?
Yeah, if possible, all of those types of accounts and maybe more, because it helps with tax diversification, which also helps with the way your income is taxed, right? As the dollars come out of those accounts. If all of your money is in pre-taxed accounts, like a TSP, 401k, 403b, 457 plan, more than likely the majority of it, if not all of it, is pre-tax and it hasn't been taxed. So of course, if you can add in a Roth, if you can add in a brokerage account, taxable account that's, where you're getting dividends and interest and capital gains, obviously that's going to help to offset the ordinary income coming from your pre-tax account. So yes, a lot of advisors recommend having that tax diversification. We call it asset location, right? Everyone knows what asset allocation is. That's where are your dollars invested, like in what instruments, right? Stocks, bonds, and different financial instruments. But the asset location, the location of those dollars, in our opinions at Abich Financial, is just as important as a dollar amount. Because what good does it do us if we have 3 or 4 million saved and then we get to the retirement table and goal line and we find out all of it's pre-tax, and then every single dollar coming out of those pre-tax accounts is taxed at ordinary income when our taxes could be higher in retirement. And that's a tax surprise that I think a lot of our clients find out and realize at the conference room table. When they find out they can retire successfully, wow, I wish I would have known this 20 years ago. I wish I would have thought about tax diversification. So yes, many advisors do recommend having a combination of those, 3 types of accounts, pre-tax, Roth, and taxable accounts, because it can help with tax diversification, which can help your income to be as tax efficient as possible in retirement. Yeah. We just recently met with a couple out of Fairfax, Virginia, $4 million accumulated, retiring in a few years, mid-60s, no tax diversification, and putting together a tax plan, putting together a tax mapping report, an analysis of where all your dollars are and what the taxable consequences will be of where those dollars are and when they come out, what will happen, is a pretty new thing for most people that we meet with. Because again, the focus has been on the dollar amount, not where the dollars are as much, right? It's the amount. I need to get to $1 million. I need to get to 2, 3, 4, 5, 10 million, whatever it is. So putting together a tax plan now we're starting to think about, as a retiree or pre-retiree, all right, I got my number. I can retire at 65 or 62 or 68 as I've always wanted to. I hit my goal. Yep. Now what do I need to know? Now what do I need to be prepared for as I cross the finish line successfully into retirement? And taxes could be way higher down the road than they are today, and could be one of the biggest risks that could eat into our nest egg and life savings if we're not prepared for it. So having all of our dollars in a pre-taxed account that comes out as ordinary income when we have fewer deductions in retirement, and if that tax code changes, and as all this RMD income kicks in, if you have an inherited IRA or at 73 and beyond out of your own IRAs, and 401ks and TSPs, can create a huge tax surprise and a huge potential tax nightmare if we're not proactive about putting together a tax plan. Start to tax diversify, start to consider where all those dollars are and what you can do right now to lower and mitigate taxes on your life savings as much as possible. We helped this couple out of Fairfax, Virginia, put together a tax plan with that tax mapping report and analysis that's monitored and discussed typically annually with our clients, usually several times a year over the course of a calendar year. If you're listening right now, you're 55 years old and older, you've saved $500,000 or more that we can help you to manage. You need to find out how to tax diversify yourself so all of your eggs aren't in one tax basket. Yeah. We want to offer you that tax plan complimentary.
Abe and his team, they're here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m. and 5 p.m.
Abish Financial Wealth Management is an SEC registered investment advisor. Registration does not imply a certain level of skill or training, and the SEC has not approved or verified this communication. Abish only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. This material is for general informational and educational purposes only and is not individualized investment, legal, or tax advice. Investment advice is provided only after engagement under an appropriate advisory agreement. Structured notes, annuities, Roth conversions, and related strategies involve risks and may not be suitable for all investors. Structured notes may involve issuer credit risk, limited liquidity, capped or conditional returns, loss of principal, and protection features that may not apply in all market conditions. Annuity guarantees depend on the financial strength and claims-paying ability of the issuing insurer and may be subject to caps, restrictions, fees, and surrender charges. Roth conversions are taxable events, and outcomes depend on individual circumstances, future tax rates, and investment performance. Third-party rankings or recognition are not guarantees of future results, endorsements, or representative of any client's experience. Criteria and fee information are available upon request. Any hypothetical or illustrative scenarios referenced in marketing materials are for demonstration purposes only, do not represent actual client experiences or guaranteed outcomes, and should not be relied upon as predictions of future performance. Investors should review all offering documents, understand applicable risks, and consult qualified financial, tax, and legal professionals before acting. Past performance does not guarantee future results. Endorser is not a client, and this testimonial has been compensated. Opinions are their own. Compensation may create a conflict of interest. Testimonials may not be representative and are not a guarantee of future results.